Hello and welcome to CBN Talk Today, a podcast from the Central Bank of Nigeria. I'm your host, Ejike Agu, and today we'll be talking about regulatory measures to improve lending to the real sector. My guest is none other than the Acting Director of the Banking Supervision Department of the Central Bank of Nigeria, Dr. Adetona Adedeji. Hello and welcome, sir.
Thank you, Ejike.
Thank you for joining us today.
You're welcome.
Now, I must say I've been looking forward to our conversation because in this era of reform, your department in particular, BSD, has been very active. So I'm very glad that you're here to shed some light on some of the policies that are coming from your department. Thank you again for being with us.
You're welcome. My pleasure, Ejike.
Yes. The governor of the Central Bank of Nigeria has mentioned on many occasions that in line with the bank's strategy to refocus on the bank's core mandate, the Central Bank of Nigeria will be utilizing orthodox monetary policy tools to implement monetary policy. Of course, from the last two MPC announcements, we've seen that we're more in a contractionary stance, tightening, if you will. This has led to a review of the loan-to-deposit ratio required of commercial banks to hold. Can you shed some light on this for us today, sir?
Yes, thank you, Ejike. You have said it all. You mentioned contractionary stance, but before going there, let me start with LDR itself. You know, loan-to-deposit ratio is a kind of metric that is used to evaluate banks' lending activities relative to their deposit base. This rate, that is LDR, is very crucial when you are assessing the capacity of our banks in terms of lending. And also, it is very crucial as well in managing risk, as well as ensuring financial system stability. Then let's go memory lane a little bit, or let's go historical. Prior to 2019, it was observed that there was a serious slowdown in credit growth, and that led to the introduction of a regulatory measure to encourage or to increase lending to real sector of the economy, which is generally referred to LDR policy. This particular policy was aimed at ensuring that money flows into the real sector of the economy. This policy, among other things, then set a minimum threshold for LDR, first at 60%, then later increased to 65%. But when you talk of the contractionary targets as of now, we look at what happened when it was increased. There was an observed boost in the industry credits across all sectors of the economy at the time. So when you experience such, there will be a kind of multiplier effect based on the impact it will have on the activities in the economy, productivity, employment, and all that. Then, after that, the current development in the economy, the central bank management has adopted a tightening stance to combat inflation. And if you want to combat inflation using the orthodox method you mentioned earlier, you got to balance what you do with the monetary policy tools and other measures you can use to achieve your objective. If you look at when you say contractionary stance or contractionary measure means that you want to reduce the money supply. And when an economy is experiencing an inflationary pressure that we are experiencing, and central bank has decided to use an orthodox means. So what you want to do is that you want to ensure price stability. In ensuring price stability, you have different ways of achieving this. And one of the ways that are commonly open to monetary authority is for you to tamper or to adjust the money supply. And if you want to do that, you want to maybe reduce the money supply, something like loan-to-deposit ratio you have mentioned, what you need to do is whatever level it is, you have to do what? You have to bring it down. Bringing it down means you are curtailing that ability of banks to lend more to the society. You are curtailing the ability of banks to pump in more money into the circulation. So, in line with the contractionary stance of the management of Central Bank of Nigeria, the only thing we can do at that point to align with what we have done, combating the inflationary pressure, is for us to reduce loan-to-deposit ratio. That is exactly what we have done.
Now, Doctor, it's good to have the doctor in the house, because as we continue to experience, rise in inflation, I think the latest numbers say we're at about 33%. The central bank is doing all it can to bring down this inflationary pressure. Can you give me the connection between reducing the loan-to-deposit ratio and the transmission effect on general inflation and price outside?
Like I said, when I was talking about recent inflationary pressure, and when you have this kind of situation, you want to put it under control. One of the approaches is for you to mop up the excess liquidity in the economy, and that is to reduce the quantum of the money supply. And you could see that is already reflected in the decision taken by the MPC when they increased the monetary policy rate, and also they increased the CRR. So if you look at the two they did earlier, monetary policy rate, when you increase the rate, the effect is that it will limit the ability of people to go to and approach a banker, I want to borrow. So even if I can afford to borrow, it will reduce the amount I will say I want to borrow. So that is exactly what that policy means. And by so doing, it will limit the quantum of money that will go find its way into the economy or into the circulation. But loan-to-deposit ratio, if you say you want to achieve a contractionary, you understand that your policy stance is contractionary, and you are doing something will be counterproductive, that is, that will give the bank the ability to lend more money. Because as they are lending more money, as they are giving credit, what they are doing directly there is to increase the money supply. And that is exactly what we're trying. The objective is contractionary. But when you leave the banks for them to go ahead and increase the credit at will, then it means that position is tantamount to expansionary stance. So the management and monetary policy committee has already announced to the whole world that what we're doing is contractionary. So it will be counterproductive on one hand to be doing that, and on the other hand to be doing something that will look expansionary or have an expansionary effect on the economy. So why? Because there is an inverse relationship between the loan-to-deposit ratio and MPR and CRR, you understand, vis-a-vis the desired objective.
Just for our listeners at home, MPR is the monetary policy rate,
monetary policy
and
rate,
the CRR is the cash reserve requirement.
So if you are going contractionary, you have to increase MPR and also increase CRR. But having established what you want to do, to achieve that further, from the point of LDR, what you can do in that regard is to do what? Is to reduce. So that's why I said there is an inverse relationship in desired objective of what you want to achieve using CRR and MPR. If one is going this direction, for you to use LDR to achieve same objective must be in opposite direction.
Yes.
So now that we have increased the MPR and also increased the CRR because we want to achieve contractionary objective, LDR also must be adjusted, and in what direction? Direction by it, bringing it down.
It sounds to me like an ancillary tool to fine-tune
That's correct.
the contractionary
that's
stance.
correct. That's correct.
Thank you very
So,
much.
and vice versa. Because if the opposite is the policy stance of central bank, so what we are going to do, instead of reducing it, we are going to increase it.
But that's not what we want to do now.
But that is not
Yes,
what
that's
we're doing now.
expansion.
So, because it is contractionary stance we have for, so we have to reduce. So that will curtail, like I said earlier, the ability of commercial banks and any other deposit body banks that are into lending to curtail their ability to lend more money. Yes.
I'm with you. So this means, if I follow you, with less money to loan out to the general public, of course, that will reduce money supply in the system.
That's correct.
And by reducing money supply, the intention is that demand will also be reduced as well.
That's correct.
Therefore, we may not have as many people after so much money to have more money to buy fewer goods.
That's correct.
So if there's less credit out there, people might have less credit to spend on projects, and that may in turn encourage businesses to reduce their prices because they want to attract customers. So this might be a run-on effect, perhaps, or do you see it a different way?
Yes, thank you, Ejike. Then you are taking me to the realm of economics now.
Which is true. And are you an economist,
Yes,
sir? Let me
yes,
verify.
Yes, I am an economist. Yes, you are very correct. You don't even need to be an economist to know the impact of this. Let's go like this. When you reduce the money supply, naturally, the rate of interest will go up. Why? I'm starting from money supply now. I can start from increase in the rate, which is MPR. So, but let me start from money supply. If you reduce the quantum of money in circulation, what it means is if the fund, loanable fund that is available to the banking sector is, as an hypothetical example, is 1 trillion. If you reduce it to, let's say, 500 billion, if the number of people that wanted to borrow money when it's 1 trillion has not reduced, the pressure on the available loanable fund will do what? We make the interest rate to go up.
Because of higher competition for these loans.
So when interest rate goes up, many businesses will not be able to afford the current rate. And if they're unable to afford the current rate, it then means the credit to that particular sector where these customers have come to, the credit supply to them will do what? Will go down. When the credit supply to them goes down, of course, it will impact on their ability to expand maybe their productive endeavor. And if that happens, the number of people, of course, the salary, the wages at that point is not likely to go up. If it doesn't go up, you're not likely to afford many things. If it will curtail level of production to a certain level, at that point, like you said, the demand is likely to do what? To go down. So it will get to a point at equilibrium when things will start coming to normalize. We try to combat inflation using different ways of doing it. Even if we start from monetary policy rates going up, money supply coming down, you are still coming to the same thing. So because the ultimate objective is for us to do what? To combat inflation. And that is exactly what central bank is doing today. whatever it takes to fight inflation, we're going to do that. Though, fine, it will have some impact in some area, but some people, some analysts will argue it will affect economic growth. Yeah, fine. But if you look at the traditional Phillips curve, you can't fight two things at the same time. There will be trade-off. If you are fighting inflation, you cannot fight unemployment at the same time. If you are going to fight it, to be not up to the desired level. So you have to choose, either you fight inflation or you fight unemployment. And the two are both macroeconomic objectives that are very critical to the development of economy. But we are saying, if you are talking of economic growth, it's because economy is irrelevant, is available. That's why you're talking of economic growth. But if you look at an economy that inflation has killed, you not even talk of economic growth in the first place. So it is very important we concentrate, we fight inflation. By the time we bring inflation down, we start talking of economic growth.
The loan-to-deposit ratio was reduced by 15 percentage points from 65% to 50%.
Yes.
Now, without getting too technical, of course, can you shed some light on the significance of this particular decrease?
Yes. Vis-a-vis the objective, vis-a-vis this policy stance of Central Bank of Nigeria. Like I explained earlier, if you say you are pursuing contractionary measure as a monetary authority policy, you will not want to encourage something that will also be expansionary in nature. We have increased the policy rate, which is MPR. We have increased CRR after we have announced to the whole world that we are going contractionary. Of course, the loan-to-deposit ratio, which suggests that the certain percentage of your deposit which must be lent to your customers. So if you allow it to be at the level it was before the increase in the MPR and increase in the SCRR, then it will be counterproductive.
I get that, but I'm more asking about the percentage reduction. Why settle on 15%?
Oh, yes. If you look at the rate at which CRR we move CRR from 32.5 to 45%.
Yes.
That is how many? That's about 13 point something.
Yes.
So what we did for LDR was to be around the same corridor, so to reduce it. You know, banks must still continue with their intermediation function. We have only reduced, we have not removed. Yeah. Because removing it, bring it down to zero, means they must not lend again.
You cripple the banks.
Exactly. So we have only reduced it. And we have reduced it in line with the policy measure of Central Bank and MPC, which is contractionary. Assuming it's expansionary, don't be surprised. Even from that 65, we say we are going to 75, 80. How about because it's contractionary, we reduce it?
How do all these rate adjustments improve lending to the real sector now? Because from what I'm hearing, you're actually reducing access to credit.
That's correct.
So how does this reduction in access to credit
Yes.
improve lending to the real sector?
Yes. You know, when this policy commenced, since 2019 it was introduced, we have had a kind of sustained credit growth in the industry. But now with the reduction, it will not impact negatively. It will only help the bank to improve on their credit quality. You know, sometimes it's not the quantum of credit that you are able to churn out that matters, but the quality of the credit you are able to package. And what do we mean by quality credit? That is a quality risk assets. Where you have packaged because they said loan to deposit ratio should be this much, is this high, and the bank is recklessly giving out this loan without minding whether those who are giving this loan to have the capacity to pay, or, you know, and to the extent that you are not mindful of your risk management practices within your system, such that most of these credits are now going bad. Of course, it's useless where you have that. But where you have a percentage that's not up to that, and the quality of your credit is of high standard, of course, bravo. So the reduction is marginal, not so significant. It won't have so much impact on lending to the real sector. What banks will do is a business decision. They will prioritize their lending and ensure that they have a very good quality risk assets. That is why, in short, it will be advantageous to them. No, and also, as time goes on and we are monitoring the development, of course, if there is need for management and the MPC to adjust by increasing, of course, it will be done. But for now, this is a constructionary stance, and we have done that. But that does not take away the function of banks as primary function as intermediation. We have only reduced, we have not eliminated. No. So it's just a reduction. So, of course, it won't have a negative impact on the credit to risk sector of the economy. That I believe. Thank you.
Is it fair to say that by improving the quality of these loans, banks might also bring down the ratio of non-performing loans?
That's correct. That's what to be. When we say good quality of risk asset, we are talking of non-performing loans. The non-performing loans will naturally come down. And that's why I said it is not even about how high, but the risk management practices. The monetary arrangement of the bank compliance, yes, that will make sure that, okay, if I give out loan, I'm sure that 99.9 of them I'll be able to recover my money. So that's more important than just giving out, maybe have a very high loan to deposit ratio and not getting it. So the main focus should be the few ones I'm able to give to risk sector or any other sector for that matter, how quality are they?
And that could actually bring up the credit rating of the banks and their resilience as well to shocks.
That's correct, because, why this is very important is there's what we call capital adequacy ratio. Yeah. What is making the bank's capital adequacy ratio to be coming down is because of NPL. It is non-performing loans. And when you have so much non-performing loans, do you know where it goes to?
Where does it?
It hits into your capital.
Of the banks?
Of the bank. That's why when you look at it, the recent recapitalization exercise, you see what we have done. That we're saying we're not going to consider certain reserves, but instead we're going to use the issue paid up capital as well as share premium.
Yes.
We know that others too belong to shareholders. But we want fresh injection of capital into the economy and that will serve as a tier 1 capital. That's what we call tier 1 capital. And the loss absorbency of this type of capital is very, very high. Very, very high. Equity shareholding. Look at what happened under this exchange rate volatility that was never planned for. Even when banks were doing their forecasting for the 2024, I doubt if any bank will be able to predict the exchange rate will get to 1,500 or 1,800 as it was earlier, before the measures taken by management of central bank has been able to bring it down to where we are today. So look at that. And most of these banks, if they are exposed through the foreign contract, foreign exchange transactions, by the time they are doing the revaluation, there's what we call revaluation gain and revaluation loss. So if they're on the side where they are going to record revaluation loss, that's it. And what will make you to CBN in business to be a going concern, it is how strong your capital is. It is your capital that will be able to absorb the losses. And that's why at any point in time, you are saying you must have capital that will be commensurate with the quantum of risk you are carrying. At any point in time, the capital you are carrying must be commensurate with the risk you are exposed to. So I think we're good.
Doctor, thank you so much for that illuminating conversation. I really appreciate it.
Thank you, sir.
So the central bank continues to improve lending to the real sector through stronger credit in the banking sector.
Yes.
Thank you so much, sir. And please feel free. You're always welcome to be a guest on our show.
Thank you.
Well, that concludes this episode of CBN Talk today. Once again, I'm your host, Ejike Agu. Thank you and goodbye.